How do investment gurus like Jeremy Grantham make money, especially when a recession looms around? What are the investment strategies that have helped them to amass a huge amount of wealth? Let's see. Jeremy Grantham is a British investor and co-founder and chief investment strategist of Grantham Mayo Van Otterloo, a Boston-based asset management firm. Famed value investor Jeremy Grantham says the best returns on investments don't come from taking the biggest risks, but from buying the cheapest assets. He says the less an investor pays for a stream of earnings, the higher the chances of his return over time will be. You don't get rewarded for taking risks, you get rewarded for buying cheap assets. If the assets you bought got pushed up in price simply because they were risky, you're not going to be rewarded for taking the risk. You're going to be punished for it, he told investors in his quarterly letter. Grantham's investment strategy is built on the idea of mean reversion. He makes his investment choices by looking for irrationally priced stocks. He says financial assets can be too expensive or too cheap at any given moment, but will always go back to average. The worst thing investors can do is to get in or out of an investment for the simple fear of lagging behind their peers. Grantham has a reputation for accurately predicting about 3 major market bubbles: Japan's asset price bubble in 1989, the dot-com bubble in 2000, and the US mortgage crisis in 2008. Grantham believes that individual investors are at an advantage. Why does he think so? Grantham says the basic truth of investment is that investor behaviour is driven by career risk. He feels most investment managers fear taking bold calls and prefer going with the flow and doing what their peers are doing because it's the safest option to survive in the investment industry. Grantham says individual investors can take advantage of this practice of investment, as it creates herding and thus drives prices well above or below their fair values. The prime directive is first and last to keep your job. To do this, you must never ever be wrong on your own. To prevent this calamity, professional investors pay ruthless attention to what other investors in general are doing. The great majority go with the flow, either completely or partially. This creates herding or momentum, which drives prices far above or far below the fair price, he says. Giving the example of the internet bubble, he says companies that were suffering big losses and had no future were getting billion-dollar valuations, and fund managers were buying them at excessive prices just because they feared missing out or deviating from the performance of their peers. Grantham tells all investors to believe in history. In investing, history tends to repeat itself, and all investment challenges pass away in due course. Investors should try to survive the tough times and ignore the vested interests of the industry, which tries to mislead them from time to time about the market, says Grantham. The market is gloriously inefficient and wanders far from fair price, but eventually, after breaking your heart and your patience, and for professionals those of their clients too, it will go back to fair value. Your task is to survive until that happens, he says. He also cautions investors against borrowing and lending. An investor's ability to survive in the market is typically hampered if they intend to borrow money for investments. The allure of borrowing has been so strong that many have demonstrated they're unable to resist it, treating it like a narcotic. Portfolios that are leveraged can be stopped, but those that aren't can't. Leverage diminishes patience, which is a vital asset for investors. Greed, irresponsibility, and financial aggression are encouraged. It keeps increasing your profits until all of a sudden it ruins you. For individuals, it enables them to have today what they otherwise wouldn't be able to buy tomorrow, he claims. It's advisable to diversify your investments rather than putting all of your money into one, since a portfolio with multiple holdings is more resilient and can weather market fluctuations. He states, "It's obvious that the more diverse and numerous your investments are, the more likely it is that you'll weather those crucial times when your major wager loses out." To take advantage of favourable market conditions, investors must be patient. The market will constantly experience ups and downs. Therefore, when a good investment opportunity presents itself, it's advisable to invest for the long term. Wait for the good cards. If you've waited and waited some more until finally a very cheap market appears, this will be your margin of safety. Now all you have to do is withstand the pain as the very good investment becomes exceptional. Individual stocks usually recover, but entire markets always do. If you followed the previous rules, you'll outlast the bad news, he says. Compared to professional managers, individual investors have a significant advantage because they're only responsible for reporting their performance to themselves. They also don't have to worry about losing their jobs or having to equal the market's return every year. Individuals can afford to keep a temporary loss for a long-term winning solution. Unlike professional investment managers, which is a big advantage for a number of reasons, including minimizing taxes and transaction costs. Individuals can also afford to keep a temporary loss for a long-term winning conclusion, unlike professional investment managers, which is a big advantage for a number of reasons, including minimizing taxes and transaction costs. The individual is far better positioned to wait patiently for the right pitch while paying no regard to what others are doing, which is almost impossible for professionals, according to him. In the world of investing, optimism is frequently seen as a beneficial survival trait, but it has a drawback, particularly for investors who find it difficult to accept negative news. This was an example where the stronger the case was made, the more unpleasantness it elicited, he says. In a real stock bubble like that of 2000, bearish news in the US was received like news of the bubonic plague. Bearish professionals were fired just to avoid the dissonance of hearing the bear case. Investors need to learn to weigh the pros and cons of the investment sector and avoid being overly hopeful. One should be willing to hear bearish bad news about the risks they've taken with their capital and make informed decisions about them. Expert investors can and often do recognize good deals, but they're not always able to take action on them. This is because seasoned investors don't want to take the chance of falling behind their colleagues and losing their employment in the event that an investment bet doesn't work out. However, Grantham believes people shouldn't worry too much and should believe their research if they come upon an inexpensive investment, even though it might go out of style soon. You can make bigger bets than professionals can when extreme opportunities present themselves, because for them the biggest risks that come from temporary setbacks, extreme loss of clients and business, doesn't exist for you. So, if the numbers tell you it's a real outlier of a mispriced market, grit your teeth and go for it, he says. Investors should look to calculate estimates and forecasts of an attractive investment proposition by using simple methodology and shouldn't let any external factors affect their research. These estimates are not about nuances or PhDs, they're about ignoring the crowd, working out simple ratios and being patient, he says. To become successful, investors must know their limitations as well as their strengths and weaknesses. If you can be patient and ignore the crowd, you'll likely win. But to imagine you can, and to then adopt a flawed approach that allows you to be seduced or intimidated by the crowd into jumping in late or getting out early, is to guarantee a pure disaster. You must know your pain and patience thresholds accurately and not play over your head, he says. He also believes that if investors cannot resist temptations, then they should absolutely not manage their own money. People can either hire a manager who has those skills to manage their money efficiently, or they can pick a sensible, globally diversified index of stocks and bonds for investment, which they should never look at again until they retire, he says. Grantham also feels that if individuals have patience, a decent pain threshold, an ability to withstand hard mentality, some basic college-level education in math, and a reputation for common sense, they can be successful in the investment world. In my opinion, you hold enough cards and will beat most professionals, which is sadly but realistically a relatively modest hurdle and may even do very well indeed, he says. He advised against investing in the United States due to the $33 trillion debt issue facing the country, the high interest rate environment, the unsustainable high yield levels, and the significant difficulties in the mortgage and real estate sectors. Instead, he pointed to developed markets like the United Kingdom, Japan, and most of Europe as being good and cheaper alternatives to investing in the US. In general, the rest of the world seems investable, he says. Do your analysis, make your mistakes, etc., but it's reasonable. That's it, guys. Prepare your investment strategy by doing your research about the stock market. If this video helped you, give a thumbs up. For more videos like this, subscribe to our channel and turn on the notifications. See you around.